Donald Trump nominates longtime ally Pam Bondi to run the U.S. Justice Department after his first choice, Matt Gaetz, bows out of the running. Bitcoin climbs closer to $100,000, fueled by Trump's embrace of crypto. Plus, Israel rejects the International Criminal Court's arrest warrants for Benjamin Netanyahu over alleged war crimes in Gaza, calling the charges absurd and false. So we have a lot of news today, not only in geopolitics, of course, some of the nominations of Donald Trump, also moving markets, and then we have some data coming up in terms of Eurozone PMI. So let's get straight to European markets. For the moment, you see there's a bit of a lift on the DAX yesterday, maybe catching up to some of the losses that we saw yesterday. The DAX, the FTSE, but also the CAC, and here over the FTSE bib over an inch, gain between 0.2 and 0.6%. Now, I am watching some of the commodity-rich, of course, industries across the world. We're getting some Euro area zone PMI. Manufacturing actually falling to 45.2. The estimate was 46. A reminder, anything that's below 50 indicates a contraction. And then the services PMI falling to 49.2. So that's also just below contraction. The forecast was 51.6. Cross asset, a lot of focus, of course, on Bitcoin. We're now flirting with 100,000, 98.845. Brent, 74.69. This is on these renewed tensions in the Middle East, but also Ukraine. And then the 10-year yield just below 4.4 at 4.3963. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President-elect Donald Trump is nominating the former Florida Attorney General Pam Bondi to run the U.S. Justice Department. Now, that's after his first pick, Matt Gaetz, withdrew from consideration. For more on this, let's bring in Bloomberg's EMEA News Director Roz Matheson. Roz, I don't know whether it means that Donald Trump is actually getting some pushback or whether it means that he thought that it'd be better to change candidate because Gaetz was so controversial that it would actually hurt the goodwill from senators.
Well, it's interesting to see that he did actually withdraw from contention late yesterday, citing what he said was the distraction around him for this nomination, because, of course, he's carrying a lot of baggage. He was, the subject of several investigations into alleged sexual misconduct allegations. He denied, but the noise on that was very intense, and also reports about the fact that his campaign has spent a lot of money on e-processing services through Stripe during their campaign in 2024. So part of that was just the intensity of the noise around him. But interesting to see, what we were hearing is that quite a few Senate Republicans were expressing concern around his nomination. So an early sign that not everyone in the Senate, Republicans included, may fall into line automatically on Donald Trump and his policies. But in a way, what he gets in place of Gaetz is someone who's a very experienced conservative lawyer. She's obviously a fierce ally of Donald Trump. I mean, she served on his defense during his first impeachment by the House in 2020. She's repeated his baseless claims around fraud in the 2020 election. She's also said on the many DOJ moves against Donald Trump that these are laced with politics. So she'll certainly be someone who will enact or try and enact his policies at the DOJ, but she does come with that political and legal baggage that Matt Gaetz was carrying.
And still no Treasury Secretary, Roz. Why is it taking so long?
Well, it's interesting to see on the Treasury Secretary, that's the one appointment we're still really waiting for. And there seems to be, a lot of jostling between contenders for it, but also slightly differing views in Trump's inner circle about who would be best placed to take that role. But obviously it's significant whoever does. We've seen, for example, Donald Trump still wading in on policy around, for example, the Federal Reserve, even though Jerome Powell has pushed back against that. So it's obviously going to be a really important appointment either way. And interesting it's taking so long. And it does show, again, that not everything is quite as automatic around Donald Trump as we thought. Yes, he's got a lot of his people in place already. He's nominating people who are close to him, who might have perhaps not really that much experience in the role that they're nominated for. But this one seems to be particularly tricky, and it's very interesting to see that.
Ross, thank you so much, as ever, for your insight. Ross Matheson there, Bloomberg's EMEA News Director. Now, we have a couple of things in terms of PMIs weaker than expected on both fronts. Services also now indicating a contraction, euro falling to the weakest level since 2022 against the U.S. dollar. So to talk about PMIs, but also the wider, of course, European economy, underneath this white area data, the contraction in Germany's private sector activity worsened in November. In France, activity plunged at the quickest rate since the start of the year. Now, in a moment, we'll speak to Goldman Sachs' Christian to get a sense of actually what happens next. And this, of course, is in a context also of possible trade wars and trade tariffs from the U.S. Now, let's bring in Zoe Schneeweiss, who heads up our Western Europe economy coverage. Zoe, thank you for joining us. I mean, it's not great, actually. If you look at the private sector, it kind of slipped in a contraction, and we were not expecting it.
Yes, those numbers are quite atrocious, really. And the issue here is that we've known for a while now that manufacturing is in trouble. But services also going below that vital line of 50 just shows that there are deeper problems here. And I'm not surprised in a way with Christine Lagarde today in this speech that says Europe needs to get its act together. Similarly, the central bank chiefs of France and Germany put out a joint op-ed saying, Europe, you're in a time of crisis. Please finally do something. But these numbers obviously are quite concerning.
Zoe, I mean, if you put this into context, and I know Christian will weigh in to try and figure out exactly what Europe can do in terms of competitiveness, but how difficult is it to try and get your act in order when you have looming tariffs or a possible trade war from the U.S.?
Those definitely don't help. A lot of the issues, though, are homemade. And if you look at those big two economies, France and Germany both have more than enough political issues right now as well. As we know, Macron did call those elections, now doesn't have a majority in parliament. Similarly, Scholz called early elections, is very likely to lose that top spot, probably not be chancellor anymore. So there is these homemade things, and then Europe does not have a united front, in a way, on what to do about Trump. They could have started planning on to Trump-proof, basically, Europe. They had 4 years to Trump-proof Europe, and they did very little. And it is, just watching this as a commentator, is quite depressing.
Zoe, thank you so much. Never mincing our words. Our Zoe Schneeweiss, of course, looking in charge of our European economy coverage. Now, we're joined by Christian Mueller-Glissman, head of asset allocation research at Goldman Sachs. Christian, I mean, I don't know whether to start actually with the fact that Europe needs to get its act together, or we don't really know what the policies of the U.S. are, but so far the nominations are pretty rattling in terms of, blowing up the system.
Yeah, I mean, it's very clear they're increasing uncertainty. And it's not all because of the U.S. elections outcome. I think there's multiple things going on here. You have the trade policy uncertainty that has majorly spiked since the U.S. elections. And our economists actually found that there's a link between PMIs, which is sentiment surveys in particular, and trade policy uncertainty. Then I think you've had in the last few days and weeks the Russia-Ukraine conflict seemingly intensify. So that creates uncertainty. I think on top of that, because of Trump being elected and having this reflationary shift, global central bank cutting cycles have been repriced to be much more hawkish. And Europe needs lower rates. Manufacturing needs lower rates. So you have all these multiple factors currently weighing on Europe, and that has also made us being quite bearish across assets on Europe.
Christian, how much more how aggressively does the ECB need to cut rates? I mean, we had a conversation with Christine Lagarde a couple of weeks ago. Yesterday we spoke to the Greek central bank governor. I mean, traders now see a 50% chance of half a point ECB rate cut in December on the back of those disturbing PMIs.
I mean, they have a problem, of course. We have to be clear. It's not all that Trump has triggered that reflationary pricing in global central banks, but it's also the fact that inflation remains sticky a bit. Certainly in the UK, but also in the euro area, inflation has been a bit more sticky. And
services inflation,
absolutely right.
It just can't really get down like the others.
That's absolutely right. And I think it's to some extent less predictable because it's more domestic, it's more specific, it's not linked to oil, it's not linked to global factors or goods, which has been very disinflationary. So I think there is a bit of a challenge because we know the Fed cares about financial conditions, it cares about the equity market, it cares about growth. And they've already pivoted, they've shown they're responsive, they've shown they provide a central bank put. Whereas in Europe, we have obviously different mandates and a different history of being proactive versus reactive. So to some extent, the market is potentially waiting for a bit of a pivot, and that could help.
But, Christian, so if there's the 10 to 20% tariffs that kind of could be base case for Donald Trump, and again, we have to see how the market reacts. We know that he looks at the market. But does it shave off 1 percentage point of GDP automatically of European countries? And again, how difficult is it in a time where Europe is not as competitive, frankly, as it should be?
Yeah, I mean, our European economists, they've done a lot of these exercises where they try to estimate the impact of tariffs, but you can imagine it's tough. Like, there's a lot of uncertainty. And the uncertainty creates also the issue of estimating it, because it's path dependent. There's a lot of other things going on at the same time. There's a lot of sentiment components of growth and that matter. So what we've estimated, exactly as you said, is that a 10% blanket tariff would shave off 100 basis points over a period of 2 years. And it could be a bit more front-loaded, but ultimately that's the case. Our team has shaved off maybe 50 to 60 basis points for now from euro area growth, because the 10% blanket tariff is not our base case. No. But I think you can see already how the uncertainty, without anything having happened, weighs on activity. And that's what I mean. Like, the uncertainty, like, let's assume it's not a 10% blanket tariff, let's assume it's smaller, but there is an open-ended discussion that might actually keep uncertainty elevated and still weigh on growth.
But is it difficult to model? And again, does it hit different sectors differently? Yes, depends on the ones that are basically affected. But is it growth? Is it hitting growth before it actually increases inflation? I mean, could it be deflationary instead of inflationary, is what I'm trying to say.
It's a really good question again. I mean, the uncertainty effect could really weigh on demand. If you have sharp price level effects, that could weigh on demand. But then you have to consider two things. First of all, inventories in the global goods sector are very low. No. So for 2 years, you've been destocking because you've already dealt with a slowdown. So you could also see a situation, if you start with the tariffs, that people are saying, wait a second, maybe I should restock. Because if you start with the tariffs, it could continue, and it actually could create a shorter-dated, front-loaded pickup. And all these uncertainties make it incredibly difficult. And if you are an investor and if you're in the market, you just need to put more risk premium. And I think the market is doing that a bit right now.
All right, Christian, thanks so much. Christian Mueller-Glissman from Goldman Sachs stays with us. We'll talk a lot more about the U.S. economy, look at dollar, and also talk emerging markets. That's coming up next, and this is Bloomberg. Welcome back, everyone. Now, still with us, Christian Mueller-Glissman from Goldman Sachs. Christian, thanks so much for sticking around. We were talking a little bit before about what Europe needs to do to become a little bit more competitive, especially with the specter of tariffs and possible trade wars from Donald Trump. What does the Trump administration mean for the U.S. economy? So we're talking about deregulation, question marks about what role Bitcoin, frankly, has into this. He could go after Jay Powell or central bank independence. So does it change the dynamics within the U.S. economy?
Yeah, I think there's like 4 major blocks of policy that we've been focused on: deregulation, taxation, immigration, and the tariffs. And our macro baseline is a relatively friendly one. So our economists actually think that the policy mix that we're getting is roughly growth neutral. So GDP growth, we expect at 2.5% for next year, which is above consensus. Consensus at 1.9. So another year of the U.S. outperforming and possibly beating expectations. So like the policy mix, neutral for GDP growth, and it's slightly increasing inflation. So core PCE inflation type measures, because of the tariffs, we assume like a 20% tariff on China, and then tariffs on auto imports. If you have that, it will probably boost inflation by 30, 40 basis points. So that is not a terrible outcome in both relative to what we expected pre-Trump's election, but also relative to the rest of the world. So contained inflation pressures, still good growth. But there's a lot of question marks. There's a lot of question marks on timing of the implementation of the policies, how uncertainty hurt things, uncertainty related to tariffs, And I think to some extent also on the immigration, there's a lot of question marks if you create deregulation and taxation and generate some animal spirits in the domestic economy and at the same time potentially reduce the labor supply, could inflation actually surprise to the upside?
But if you take out immigration, because that's been supporting the U.S. economy quite a lot, whether the legal or the illegal kind, I mean, does it change really the dynamics? Because we always thought, oh, this could be, the force could be productivity. But if you look at the productivity numbers in the U.S., they haven't been great.
It depends. If you look at high-frequency productivity numbers, they've actually been quite good in the last few months. And our economists have been a bit surprised by that as well. So I think currently very high-frequency productivity numbers are well above 1%. And so to some extent, that's obviously the hope. That the labor market can kind of rebalance partially via productivity. And if you have deregulation, taxation, investments, reshoring, there is a possibility, but it's a slow process normally. I think right now we know the U.S. labor market is somewhat tight. The unemployment rate close to 4% versus Nauru or versus history, it's low. So there's a certain late cycle element in the U.S. economy. So we know inflation is the biggest blind spot for investors. So we just have to be a bit vigilant next year.
Christian, what do you do with China? So again, these are, Trump tariffs that were put in place like 5-6 years ago that the Biden administration kept. But the fall in the China economy was self-made because of real estate. So it wasn't really hit that much by tariffs.
Yeah. I mean, I would say, as always, when we look at investments and economies, we want to understand three cycles: the structural cycle, the business cycle, and the sentiment cycle. So the structural cycle in China is very bad, and we don't even need to go over there. It's real estate, it's population growth, there's lots of geopolitical concerns. So let's put this to the side. We know that the business cycle has been very depressed in China. And this, as you are absolutely right, had not only to do with trade tariffs, it had to do with some of the structural issues becoming a bit more binding and weighing on the domestic economy, creating liquidity trap tendencies. And deflation, excess capacity. So I think these issues, to some extent, were trying to be addressed by policies like fiscal policy, monetary policy, going into the election already. And the sentiment was super bearish. Yeah. So putting this all together, you actually had China doing much better than most people expected this year. We had this big bounce, no? And now you're adding this new dimension of the U.S. elections with potentially more tariff, more uncertainty, more challenging structural cycles. So you could say the ball is back in the court of the policymakers now. So they need to do more because there's more headwinds.
Christian, very, very quickly, does the dollar still rally from here?
I think we had this view that we know the dollar is a bit overvalued. We know that, to some extent there's some convergence on monetary policy. So we were hoping the dollar would depreciate coming into this year. But our team has now shifted back to a dollar stronger for longer view. I think you just can't fight easily with the type of policy mix that you have in place and the strength of that economy.
So interesting. Christian, thank you so much for coming on today. Christian Mueller-Glissman, head of asset allocation research at Goldman Sachs. Coming up, flirting with $100,000. We look at Bitcoin's rally towards six figures. That's next, and this is Bloomberg. Let's talk about Bitcoin. Bitcoin currently at, just very shy of 100,000 at 98,645. Now, the crypto market has gained around $1 trillion since the U.S. presidential election. So let's get more from Bloomberg's Emily Nicole. Emily, I mean, I look at this and I think, wow, we're like a whisker away from 100,000. I mean, this is a huge psychological level. Is this all Trump trade?
I mean, pretty much, yeah. If you look at the numbers in terms of how much has gone into the US ETFs since the election, that's $6.8 billion. If you think about how much the institutions have kind of been positioning for this after being very cautious over the summer, we can pretty much assume that a lot of this is coming from Trump optimism, especially with the resignation of Gary Gensler overnight as well at the SEC. All of this is kind of laying the groundwork for that inauguration day and what he plans to do on his first few days in office.
I mean, what happens at 100,000? I mean, do people pile even more in, or is it just a psychological level?
It depends a little bit about how people have got their trade set up. I was speaking to somebody last night from Wisdom Tree, actually, who was saying that there's a lot of that short squeeze stuff happening around $100,000, so we may actually see a big rip-roar past once we hit that figure. But there's also a bit of an understanding about how it affects the rest of the crypto market. Will we see it spill over onto the smaller cryptocurrencies? Will Ether have a bounce? There's a general sentiment that, what's good for Bitcoin is good for the rest of crypto. But, how it exactly plays out in terms of the way people trade, I mean, Bitcoin's the number one, so.
I know. So interesting. Emily, thank you so much for joining. We'll keep on following. I mean, it could hit it today, right?
Yeah.
I mean, we're so close to it.
The US has yet to wake up, so anything can happen.
So today could be the day. Watch Bloomberg, listen to Bloomberg, read our stories as we bring you the very latest on Bitcoin. Emily Nicole there. Now, a little bit later today, also don't miss our interview with Richard Teng. He's the chief executive of Binance, so that will be, of course, a good conversation with the world's biggest crypto exchange on how he sees cryptos going forward. Coming up, Vladimir Putin says Russia launched a new kind of ballistic missile to attack Ukraine in retaliation for Kyiv's use of American and British-made missiles. We'll bring you more on the latest escalation. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump nominates longtime ally Pam Bondi to run the U.S. Justice Department after his first choice, Matt Gaetz, bows out of the running. The euro falls to its lowest level against the dollar since 2022 as euro area business activity unexpectedly slips into contraction. Plus, Israel rejects the International Criminal Court's arrest warrants for Benjamin Netanyahu over alleged war crimes in Gaza, calling the charges absurd and false. Now let's get on to some of the data that we had a little bit earlier on. Euro area business activity actually unexpectedly shrinking in November. This is a sign of the damage done being brought by political chaos, but also heightened discord over trade. So nothing's been announced from the U.S. side, but it's very clear that as people anticipated, there's a bit of a contraction, and euro area manufacturing falling to 45.6, actually 45.2 instead of 46, so worse than expected. And then the services were actually in expansion, or the forecast was for expansion. They fall into 49.2. So this is repricing how much we're expecting the ECB to cut rates, of course, in December. And I think 50% now of traders expect a 50 basis point cut by the ECB come December. All right, we're also getting some UK November services PMI. They're falling to 50. The forecast was 52. So that's kind of flatlining, or at least it's neither an expansionary or contractory. Of course, territory and then manufacturing falling to 48.6 instead of the 50 estimate. So actually, things are getting worse across the board. We'll have plenty more on that. We'll speak to Yacov in terms of the impact that some of these trade tariffs could have also on emerging markets. We'll get to that shortly. Now, Russia says it launched a new kind of ballistic missile to attack Ukraine, the latest escalation of hostilities, sending an alarming signal to Kyiv's Western backers. Now, let's bring in Bloomberg's Oliver Crook. Ollie, so what was fired and what fears does this raise?
Yeah, Francine, we had actually Vladimir Putin coming out yesterday and is sort of addressing this very directly, saying that this was a new kind of missile that they had fired, that it was a direct retaliation from the Ukrainians using UK and US long-range missiles within Russian territory. There was a little bit of debate as to whether or not this was technically an intercontinental ballistic missile or a sort of more interim-range missile. The point is, though, Francine, this is a missile that traveled 1,000 kilometers from the Caspian Sea. You can see there into Ukraine. It is the kind of missile that can carry a nuclear warhead, and it came the same week that Vladimir Putin really diminished the sort of level at which Russia would consider retaliating with nuclear force to attacks within its borders, coming at a time also when we got reporting that Vladimir Putin may be open to discussing sort of ceasefire negotiations, beginning those with Donald Trump. So it's very difficult to parse how much of this is sort of an organic escalation of this conflict, how much of it is sort of an escalation with a view to potentially negotiate negotiating a ceasefire in which everybody wants to be in the strongest possible position. And of course, the difference between those two is absolutely sort of fundamental. We did hear from the Kremlin, the spokesman Dmitry Peskov says that Russia holds responsible positions to prevent a nuclear conflict. We also understand from the Pentagon that the U.S. was alerted by the Russians that they were going to fire this missile through the sort of nuclear de-escalation channels. That being said, Francine, this is a conflict that has not really moved the markets for the last couple of months. You have seen that change this week. You look at just at gold, for example, this week, up more than 5%, the most it's moved since April.
Yeah, do we worry about these sanctions that Russia imposed on Gazprom and the impact this could have on gas also flowing into Europe?
Certainly, Francine, because the sort of strange sort of setup that we have in this war and we've had for the last couple of years is that there is still Russian gas flowing through Ukraine to Europe. That creates a dynamic where Europe is actually paying Russia, funding its war machine. Russia is paying Ukraine for the transit fees to transfer that gas into Europe, funding its war machine. And the way that that is happening, the way that the Europeans are able to pay the Russians is through Gazprom Bank. Now we understand the Biden administration has moved to sanction Gazprom Bank. It is the last bank, the sort of last large Russian bank that is accepting payments. So this could have an effect on some of the supplies that are flowing to Europe. That being said, this is a war that's been going on for 3 years. We know at the very center of it, fossil fuels from Russia have been right at the center of that discussion. It cannot be a shock to anybody that this could be coming. There was also the transit agreement of these gas flows was set to expire anyway at the end of this year, but we have seen sort of stockpiles falling a little bit. And Francine, longer term, when you think about what the potential impact is here, this could mean that Europe will buy potentially more natural gas from the United States. This is something that Donald Trump was talking about way before the war even began. He was lambasting the Germans regularly for buying too much gas from the from the Russians. So this is something that could be welcome news for the new president of the United States, Donald Trump.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Ukraine, Russia and Germany. Now, the geopolitical uncertainty and a new U.S. administration with a stronger dollar on expectations of higher inflation is, of course, weighing on emerging markets. Our next guest says the mood music has soured, but under the surface, EM is far more insulated than the headlines may suggest. Well, Yacov Arnopolin is Emerging Market Portfolio Manager at Pimco. Yacov, always good to speak to you, so thank you so much for coming in the studio. I mean, there's so much copy in saying when you look at the real losers of a Donald Trump victory, it could be the neighbors, Canada, Mexico, and, of course, depending on what happens with the dollar, a lot of the emerging markets.
Yeah, look, a lot going on, obviously, and the reality is we're still in something of a waiting mode. Jan 20th is 2 months away. The market is trying to kind of read the tea leaves, figure out, as we say, personnel as policy. To the extent we get some of the personnel appointments clear around Treasury and NEC in the coming days, maybe we'll have a little better sense of what's the direction of travel. But certainly trying to piece together what's the puzzle going to be in EM. And as you said, certainly we're careful around Asia. Unclear what the Chinese reaction function is going to be. It seems highly likely tariffs are coming. Looking at Mexico very closely. Yeah, but the reality is, if we take a step back, since the election, the Mexican peso is down a couple of percent versus the euro, which, as of this morning, is down 4+%, right? So, frankly, Europe may be at the epicenter of trade war, of tariffs, so where the battle between U.S. and China plays out. But again, for us, we're trying to figure out how we can produce alpha for our clients. And specifically, we look at places like Eastern Europe. So Czech Republic, local bonds look quite attractive. You can see a lot of risk premium. If they keep cutting rates to the extent Europe slows down, that could be a great trade as well.
And this is despite, I mean, if even if Donald Trump goes after NATO, pulls out of NATO, or actually says something on like trade and tariffs that could impact the Czech Republic, this would be still a good deal.
Look, I think we're looking at the correlation to Europe, correlation, let's say, to the European auto industry, where Czech Republic produces many auto parts that go to Germany and so on. So there are clear links to Europe. And then, again, equally, there are plenty of countries that, as we said, can actually be winners in this environment. Certainly, Argentina, the Milei policies seem to really resonate with the Trump administration. He was the first to fly over to D.C. We've seen El Salvador bonds rallying. Bukele seems quite close to Trump. And, again, there is a hope maybe we won't get a resolution to all the conflicts in the world overnight. But to the extent the narrative changes in the Middle East, in Russia, Ukraine, hopefully we can actually price out some of that geopolitical risk premium that we've had in many of the bonds.
How difficult is it, Yacov, to look at the personal relationships, as you say, with Alex Millet and President Trump and say actually tariffs would go down? We've been trying to also figure out what happens with Modi and India, or do you focus on kind of just the immediate blanket policies?
Look, it's going to be, I think they'll be very specific in terms of going after potentially China, looking at Europe, looking at Mexico. So we've been thinking a lot about Mexico as well with a new Scheinbaum administration. Yeah. What does that mean? And the sense is, they're very aware that they will need to cut a deal. We have the USMCA, which is the old NAFTA, coming up for renegotiation in 2026. So 25 is going to be crunch time for Mexico to address its relationship with Trump. Again, I think it's a very technocratic cabinet that is going to look to cut a deal and figure out how to thread the needle there. So I think for now we are constructive in terms of inflation-linked bonds in Mexico, which is a safer asset. But there is a scenario where 2025 could be a decent year once the dust settles on the U.S.-Mexico relationship and how all of this plays out in terms of USMCA.
What do you do with Asian currencies?
Well, I think it's since I'd say careful for now, right? Careful for now until we see, as I was saying, the Chinese reaction function, see what happens after the administration, to the extent there is a weakening of the CNY fixing, how that impacts Asia. So I'd say for now, fairly cautious. And I'd say even the same goes towards India as well, allows them potentially to weaken the currency as well a little bit. So I'd say for now, if you look at our portfolio, we have very little beta to DXY, very little beta in terms of EM, right? So many of our trades, many of the overweights where we see value are far more idiosyncratic, right? Not beta, but idiosyncratic stories, places like the Turkish lira in the currency side, Egyptian pound, Nigerian naira, where they're far more insulated from DXY, from what the dollar is doing, and are, again, it's more in terms of what's going on, local policy, local rates, and how they pave the path.
Is there anything that you'd be selling off right now? I mean, again, it's January 20th that we have the inauguration, but in those 3 months, it also feels uncertain because a lot could happen because there's a power vacuum.
Well, look, the narrative in the market is that the euro is going towards parity with the dollar, right? And we're kind of seeing it play out this morning. So in fairness, we have had a lot of our FX longs and EM, some of these idiosyncratic stories, and the funding currency we've chosen in many cases has been the euro or the sterling. So that's worked nicely over the past several weeks.
Yacov, as always, thank you so much for coming on. That was Yacov Arnopolin, Emerging Markets Portfolio Manager at Pimco. I would suggest emerging markets have never been so interesting. Coming up, the demand for AI is reshaping the labor market as companies prioritize employees with AI skills over those without. We're joined by LinkedIn's Vice President and Head of Global Public Policy next. This is Bloomberg. Welcome back, everyone. Now, since 2016, the presence of AI talent amongst LinkedIn members has tripled in Germany, Italy, and the UK. As AI reshapes industries, the skills needed for jobs, of course, are evolving at an accelerating rate. Well, Sue Duke, Vice President and Head of Global Public Policy at LinkedIn, joins us now. Sue, thank you for joining us. This is also at a time where there's a lot of question marks about the U.S. economy, about cryptocurrency. It feels like there's a lot more disruption than there was 3 years ago. AI and machine learning specialists are probably amongst the ones with the highest growth. Do you see that on LinkedIn?
We certainly see that change that you're talking about, Francine. We see that change happening out in the labour market. We see that change speeding up all the time. And we know from our members and from customers that they feel it too. Fully 2 out of every 3 workers are telling us, I feel like the workplace is changing at a pace like never before. And they're asking for help to get to grips of it. And as you say, 2 of the big changes that are shaping the labour market, one of those is AI and the other one is green. And as you say, when it comes to AI, we are seeing its impact throughout the economy. We are seeing companies demanding these roles. They're going out looking for workers, not only with those technical AI skills for those workers who are building AI, but also for workers who are leveraging AI to get more productivity, get to do more work and more valuable work in their more traditional jobs. And we're also seeing workers going out. They see this happening. They want to meet this change. And so they're going out, they're acquiring those skills. We've seen a triple-digit increase in workers going out and getting these AI aptitude skills just in the past year. And today, fully 3 in 4 workers are saying to us, I'm also bringing in my own AI to work because I can see the value it's driving, and I'm not necessarily getting the training and the support I need at work. So I'm taking control of it myself.
So there was a Gartner report estimating that about 85% of AI projects fail due to a lack of skilled professionals. Does that make it actually the most lucrative and competitive space for qualified people?
What that tells you is that if we get to grips with this technology, if we empower workers to leverage this technology so they can do more, so they can add more value, we are going to see the benefit of this right across the economy. And so what it tells us is we need companies to start investing in targeted training programs. Workers are telling us they want to use this technology, they want to get the training. And so what we know from that research and what we hear day in, day out from our own members is we need to start putting training in front of these workers so that they can optimize this technology, so they can start applying it in their day-to-day jobs and getting the results that we know are there if we approach this in the right way.
Sue, what can you tell us about green jobs? Again, there does seem to be a slowdown, if not even a retrenchment, also because of politics in the U.S. Does that change what people are searching for and the offerings on LinkedIn, or will that come in the future?
Green is one of those areas that's bucking that trend. You're absolutely right. We continue to see that economic uncertainty slowing down hiring in the broader economy, not when it comes to AI, as we said, and not when it comes to green. We really see those twin transitions of digital and green reshaping the economy, and green is such a great example of that. It has continued consistently to buck that trend of a slowdown in the broader economy over the past couple of years. We saw a 12% increase in the demand for those green skills just in the past 12 months. And we continue to see companies, again, right across the economy, not just in the green sector, in construction, in professional services, in tech, going out and looking for those workers. The challenge we have right now is we do not have the workers to meet that demand. And if we continue to go at the current rate by 2050, that all-important, crucial deadline year for meeting those net zero targets, by that year at the current rate, we will have twice as many jobs out there looking for workers with green skills as we will have workers with green skills. So again, we have got to start taking a targeted approach to training workers so that they're in a spot where they can take advantage of these twin transitions that are shaping the economy, that are going to deliver that growth, deliver those opportunities, and put the economy in the strong spot that we know it can get to.
Sue, so great to speak to you. Thank you so much for joining us. Sue Duke, there, Vice President and Head of Global Public Policy at LinkedIn. Now to some other stories making news today. And Elf Beauty has responded to a short report saying the company is fully confident in its financial statements. Now, short seller Carson Block of Muddy Waters Capital, who we interviewed yesterday, said he's shorting the company's shares and suspects it has overstated revenue in recent quarters. Now, he also claims a buildup in the beauty company's inventory was due to lackluster sales. Elf Beauty says the allegations are without merit. Shares in the firm have recovered after losing as much as 16% on Block's announcement. Now, Northvolt Chief Executive Peter Carlson is stepping down after the Swedish battery maker filed for bankruptcy protection in the U.S. yesterday. The firm's bid to secure rescue funding fell short, leaving it with just 1 week's cash on hand and debts totaling more than $5.8 billion. Now, Northvolt says it will continue operations as it seeks to restructure under Chapter 11. Now, coming up, the ICC issues an arrest warrant for Israeli Prime Minister Benjamin Netanyahu for alleged war crimes in the Gaza Strip. We'll bring you the latest. This is Bloomberg. Welcome back, everyone. Now, Israel has rejected what it describes as absurd and false charges against Benjamin Netanyahu in the International Criminal Court. The ICC has issued an arrest warrant for the Israeli Prime Minister over alleged war crimes in Gaza. Well, Bloomberg's Dan Williams joins us. Dan, why were warrants issued?
Well, for some months now, the special prosecutor of the ICC at The Hague has sought from the court arrest warrants against the Israeli Prime Minister, also the former Defense Minister Yacov, alleging war crimes, alleging crimes against humanity in the Gaza Strip, including accusations of deliberate starvation tactics against civilians there. This is something that obviously is vehemently denied by the Israelis and by their supporters, including the United States, which has called such charges baseless. But what this has done effectively for Israel, which is fighting a multi-front war going on 13 and a half months now, is open up a new front, a front of international jurisprudence with this world court, as it's often referred to, calling for the Netanyahu, a elected and serving prime minister, to face charges, and Netanyahu firing back by saying that this arrest warrant is misguided, malicious, and even anti-Semitic.
So how binding are these warrants?
Very binding. There are 124 countries that are signatories to the Rome Statute that undergirds the court's authority. They are therefore required, when arrest warrants are issued, to enforce them should the person they're issued against set foot in their territory. This effectively will curb the travels of the Israeli Prime Minister, a man who, going on a quarter century now, has loomed large on the world stage and very much styles himself as a statesman. He's very well known for his speeches, for his telegenic English. With that said, there appear to be fissures already opening up in the West, including within Europe. The Hungarian Prime Minister saying just a few hours ago that he intends to invite Netanyahu to visit Budapest as a sign of defiance that Hungary will not enforce this arrest warrant. Meanwhile, in the United States, as I noted, the outgoing Biden administration has been very supportive of Israel. Potentially, the incoming Trump administration will be even more supportive. A number of Republican lawmakers already saying that they would intend to pursue legislation in the United States that would penalize any country enforcing such arrest warrants against the Israeli leadership, potentially imposing sanctions on the court itself. So this story has only just begun, and we'll see in the coming days and weeks what unfolds. This could actually mark, it would appear, potentially the unraveling of the authority of this court.
So, Dan, does Israel have the ability to overturn this, and does it effectively mean that the Prime Minister can't travel?
Effectively, yes. He will have to rethink every travel plan, every plan that would take him to a country that's a signatory at the ICC, unless presumably he receives explicit assurances from that country that the government does not intend to enforce the arrest warrant. Of course, the United States is not a signatory, can continue traveling there. As for Israeli recourse, Israel is not a signatory either. It did actually try to lodge a contest during the procedure. It's worth noting that this process was in the works at least since May, when the prosecutor submitted or announced that he was submitting his request for those arrest warrants. In that time period, the Israelis pursued counteraction within the court system. They tried to persuade it to abandon or to turn down this request. And the court, in announcing yesterday that it was issuing the arrest warrants, also noted that it was throwing out the Israeli contest submitted against the arrest warrant. So it suggests that Israelis' recourse is pretty much exhausted at this point. What it will be looking at is American actions, and on a bilateral basis, the actions of countries, for example, Hungary, most recently, that it might look to not to abide by these arrest warrants.
Dan, thank you so much, Dan Williams. Up next, to Bloomberg Brief, and this is Bloomberg.